What if the stock market gave you a subtle heads up before a crash? Imagine waking up to a portfolio deep in the red, a nightmare for any investor. Here's the truth. Major portfolio meltdowns often come with warning signs long before the damage is done. In today's video, we're uncovering 5 clear warning signs that your stock portfolio could be about to tank, so you won't be caught off guard. And if you value insights like this, consider hitting that subscribe button for more real talk investing guides. Without further ado, let's dive into the signs, and number 5 might surprise even seasoned investors. When the broader economy starts flashing red, stock portfolios feel the pain. One big red flag is an inverted yield curve, which is finance speak for short-term interest rates rising above long-term rates. Why care? Because an inverted yield curve has preceded every one of the last 8 US recessions. It basically screams that investors expect trouble ahead. Similarly, surging inflation and rapid interest rate hikes are toxic for stocks. When prices of everything are climbing fast, consumers pull back and the Federal Reserve slams the brakes by raising rates. In fact, rising interest rates typically put downward pressure on stock prices, while high inflation has historically correlated with lower equity returns. The reason is simple. Higher costs and expensive money can choke corporate profits and economic growth. So if you see headlines about inflation peaking at decades-high levels or the Fed aggressively hiking rates, that's a warning sign. These economic storm clouds signal that a recession and a market downturn could be on the horizon, meaning your portfolio might be riding for a fall. Now, a shaky economy alone isn't the only harbinger of a portfolio plunge. Even in a so-so economy, your stocks can crumble if their fundamentals start cracking. This brings us to warning sign number 2. Keep a close eye on those quarterly earnings reports. When corporate earnings start to decline broadly, it's a giant warning sign for stocks. Think about it. Stock prices ultimately follow profits. If the companies you own or the market as a whole report shrinking earnings quarter after quarter, it may foreshadow a market slide. History shows that the S&P 500 often peaks right when earnings begin to fall. In other words, the market tops out just as the corporate profit engine sputters. Why? Diminishing earnings make investors nervous, dampen outlooks, and pop optimistic valuations. For example, analysts might project lower future profits due to rising costs, weaker demand, or supply issues, and savvy investors will start selling before things get worse. Declining earnings are often an early clue of an oncoming recession or at least a stock market correction. So if you notice many companies missing expectations or cutting their profit forecasts, don't ignore it. It could mean your portfolio's growth is about to hit a wall. Pay attention to earnings calls, profit margin trends, and guidance. When earnings season news starts sounding gloomy, it's a sign to tighten your risk management, because a portfolio pullback may be coming. Now, falling profits are bad enough, but they are even more dangerous when stocks are priced for perfection. That's our next warning sign. Valuations matter. If your stocks are trading at extreme valuations, it could be a sign of a bubble ready to burst. One popular metric is the price-to-earnings ratio, how much investors pay for each dollar of a company's earnings. When PEs are way above historical norms, it means the market is super optimistic about the future. The trouble is, such optimism often turns to panic if the rosy scenarios don't pan out. Just look at broad market valuations. By mid-2025, the S&P 500 cyclically adjusted PE ratio hit one of its highest levels ever, only seen twice before, in December 1999 and late 2021. Those were peak bubble moments followed by sharp drops. Stressed valuations suggest investors are ignoring risk and assuming massive growth will justify the high prices. That works for a while, until reality returns. Warning signs include things like tiny unprofitable companies being valued in the billions or every hot tech stock trading at over 100 times earnings. When you hear phrases like "this time it's different" to rationalize eye-watering valuations, be cautious. It usually isn't different. Gravity will catch up. If your portfolio names have skyrocketed far beyond their fundamental value, it might be time to evaluate if euphoria, not logic, is driving the prices. In short, extreme valuations are often a prelude to a portfolio haircut once sentiment shifts. Notice how these signs connect. Overvalued markets with fading earnings set the stage for trouble. But there's more. Some signals aren't in the financial statements at all. They're in investor behavior. When investing starts to feel like a get-rich-quick casino, be on high alert. Excessive speculation and euphoric market sentiment are classic warning signs of a looming collapse. If everyone and their taxi driver is bragging about stock tips, or you see risky memes and penny stocks soaring just because stocks only go up, your portfolio could be skating on thin ice. One clear indicator is investors piling on debt to buy stocks. Right now, margin debt, money borrowed from brokers to leverage investments, has exploded to record levels, topping $1 trillion. Just recently, New York Stock Exchange margin loans jumped nearly 18% in one quarter, a surge eerily reminiscent of the borrowing frenzy before the 2000 dot-com crash and the 2008 financial crisis. That kind of froth suggests people are overconfident and overleveraged. We've seen this movie before. Late 1990s day traders and 2021's meme stock and cryptomania. When investors chase unsustainable gains with blind optimism, a harsh reality check often follows. Ask yourself, are stocks doubling on hype rather than fundamentals? Are new investors dismissing prudent voices and saying, old school folks just don't get it? When market chatter sounds like a bubble and everyone is afraid of missing out, your portfolio is at risk of a sudden drop. As legendary investor Warren Buffett says, be fearful when others are greedy. If the market feels extremely greedy, that's your cue to be cautious. Now we've got one final sign, and it's a big one that even many pros underestimated until it was too late. Before we continue, if you've been following this channel, you know I don't waste your time with hype or guesswork. I focus on research, real insights, and tools that can actually help investors. That's why I've partnered with The Motley Fool, one of the most trusted names in the investing world for over 20 years. You'll find my link in the description. Is the easiest way to check them out and see what they offer. That link also gives you access to special deals or discounts they have available right now. And yes, it helps support the channel too. Now let's get back to the video. A healthy stock market is like a table. It needs many legs to stand firm. If just a couple of legs are holding it up, watch out. When a few superstar stocks are responsible for most of the market's gains, it's known as a narrow market breadth, and it's a major warning sign. For instance, imagine an index where out of 500 companies, only a handful, say big tech giants, are shooting up while the majority lag or decline. That's exactly what we saw recently. At one point, only about 25% of S&P 500 stocks were outperforming the index, an extremely narrow leadership. In fact, the last two times the market's leadership got this narrow were during the Nifty 50 boom of the 1970s and the late 1990s dot-com era, and both cases ended with approximately 50% market crashes not long after. Why is this a problem? Because if those few high flyers stumble, there's no broad strength underneath to cushion the fall. It creates a fragile market. You might feel great if you own one of those winners until they finally falter and there's no one left to prop up the indexes. Warning signs here include headlines about market driven by Magnificent 7 stocks or only one sector, like tech, doing all the heavy lifting. If your portfolio's performance depends on just a couple of names hitting home runs, consider diversifying or rebalancing. A tower standing on a single pillar can topple easily. Robust, long-term rallies have broad participation. When breadth disappears, a downturn often isn't far behind. So, if you notice that only a few stocks are making all the gains while most others are struggling, it might be time to prepare for a bumpy ride. In summary, don't ignore the warning signs. If the economy is flashing distress signals, corporate profits are falling, valuations are in the stratosphere, speculation is rampant, and only a few stocks are carrying the market, your stock portfolio could be nearing a painful drop. The key is to stay level-headed and not get swept up in the euphoria. By recognizing these red flags early and acting on them, you can make timely moves to protect your investments. whether that means rebalancing, raising some cash, or hedging your bets. Remember, every market downturn in history eventually showed clues beforehand. Now you know what many of those clues look like. Nobody can predict the future with certainty, but by staying informed and vigilant, you'll stack the odds in your favor. If you found this deep dive helpful, give it a like, subscribe, and let me know in the comments which warning sign you watch most closely. Thanks for watching, and until next time, stay smart and stay safe in the markets.